All right, let's jump right into it. Today, we're going to do something a little different. We're not just going to look at a chart of Nvidia, we're actually going to walk through a professional trading plan from start to finish. And this is not about predicting the future. So it's less about guessing where it's going to go and more about how we should react. No matter what happens, that's it. Exactly. This is all about building a process you can repeat, managing your risk, and really understanding the why behind every single move you make. So here's our game plan. First, we've got to understand what just happened. We're calling it the bull trap aftermath.
Oh yeah, that failed breakout that got everybody excited.
That's the one. Then we'll zero in on the new battlefield, which is this 175 level. After that, we'll build a super strict checklist for how to execute. We'll run the numbers to see if it's even a good bet. And then we'll get into what's probably the toughest part of all, the mental game. Okay, so before we can even think about what to do next, we have to get a handle on the current situation. What just played out, and maybe more importantly, who's in charge of this market right now. You know, this chart tells a really powerful story. Not too long ago, the price tried to punch through $185. A ton of buyers piled in thinking, this is it, we're going higher. But it just fizzled, and the price came crashing down.
Man, so anyone who bought up there is now totally underwater, just hoping and praying it gets back. That's a bad feeling.
It's the worst feeling, and that's what we call a classic bull trap. All those trapped buyers, they're not thinking about profits anymore. They're just waiting for a chance to get out, which creates this ceiling of selling pressure. The whole vibe has shifted from breakout to, well, correction mode. So because we know that upward momentum is basically dead for the time being, we have to totally flip our script. We're not chasing strength anymore. Instead, we're watching to see if a key level gets defended. The whole game has shifted down to this $175 support zone. And if we zoom in here to the shorter-term chart, you can start to see a potential pattern taking shape. Some traders call it a double bottom. See how the price tagged 175, bounced, and now it's right back down there, testing it again?
Okay, yeah, I see it. It kind of looks like the letter W. So it held there once, it's back again. Is this the spot? I mean, it feels cheap compared to where it was. Should we be buying right now?
And there it is. That's that little voice inside all of our heads, the one that screams, it's the bottom, don't miss out. But this is where the pros separate themselves. That quote says it all. The trend is currently down. Your impulse to just jump in and buy here is what's called counter-trend trading, and it is incredibly dangerous. You mean it could just slice right through that support level? Without a doubt. Just buying here because it looks like support is like trying to catch a falling knife. It's pure guesswork. A professional doesn't guess. We wait for the market to prove to us that support is real. We need evidence. Okay, that makes sense. So what does that proof or evidence actually look like on a chart?
Now you're asking the right question. We get that evidence by creating a checklist, a simple set of rules, totally non-negotiable, that have to be met before we even think about risking a single dollar. This is how we turn a guess into a high-probability setup.
So here they are, the 3 things we absolutely have to see on this 30-minute chart. Number 1, the candle signature. We need to see a really strong rejection candle, something like a hammer or what's called a bullish engulfing pattern, right at that $175 level.
So basically a clear sign that buyers are stepping in with some real force.
Exactly. Number 2, that strong candle needs to happen on a big volume spike, proof that it's not just retail traders, but the big money's involved. And number 3, and this is so important, we don't buy at the low. We wait for the price to show us it has some strength by breaking above a nearby resistance level, something like $178.
Got it. So we're letting it prove it actually wants to go up first. Check, check, and check. We can't act unless we get all 3.
Only then. All right, so let's say the stars align. We get all 3 signals, the chart looks perfect, we're good to go, right?
We're close. The setup might look great, but now we have to ask a different question. Is it a good business decision? We have to forget about the pretty pattern for a second and just focus on the cold, hard numbers. The math has to work.
And that brings us to maybe the single most important calculation for any trade, the risk-to-reward ratio. For this specific setup, it comes out to 1 to 4.2.
Okay, 1 to 4.2. I see the number. But break that down for me. What does that actually mean for my money?
It's actually really simple when you put it this way. It means that for every single dollar we're prepared to lose if this idea is wrong, we have the potential to make $4.20 if we're right. You see, you don't have to be right every time to make money. Your winners just have to be a lot bigger than your losers. And when you look at it that way, this is an A+ setup. Okay, so let's put some actual numbers on this. Let's say we get our signals and we enter at $176.50. The very first thing we do is place our stop loss at $174. That's our line in the sand. Our defined risk is $2.50 per share, period.
And on the flip side?
Well, our first target is up at $181, which would be a $4.50 reward. And the second target is way up at $187, which would be a $10.50 reward. The key thing here is that everything, our entry, our exit if we're wrong, and our targets if we're right, is all defined before we even think about clicking that buy button.
Okay, this actually feels really solid. We've got a location, we've got a checklist, the math is great. It almost feels foolproof.
It feels that way, doesn't it? But now we have to talk about the hardest part. Because having a great plan is one thing. Actually executing it when you're under pressure is something else entirely. And the single hardest part of execution is honoring your stop loss.
This slide right here shows the two paths the trade can take if it goes against us. The professional sees the price hit $17.40 and sells instantly. The plan didn't work out. It's a small, planned loss of $2.50. You preserve your capital, and you live to trade another day.
Yeah, but that stings, you know? It's tough to admit you were wrong. My first instinct would be to just wait, to think, it's just a little dip. It'll probably come right back. Let me just give it a little more room to breathe.
And that right there is the hope that absolutely destroys trading accounts. Hope is not a strategy. Because while you're hoping, the price cascades down to 155. And that small, manageable loss you could have taken has now morphed into a catastrophic loss that just wiped out weeks of hard work. Which brings us to what might be the most important lesson of this entire breakdown. Taking a stop loss isn't you admitting you failed. It's a business expense. It's a tool you use to stay in the game.
Wow. So taking that small loss is actually a win in its own way because you stuck to your plan?
That's it. That's the huge mental shift. When you can start to see a small, planned loss as a successful execution of your risk management plan, that's when everything changes. It's a professional skill you practice. It's not a personal failure you have to feel bad about. So that really leaves us with the final question you have to ask yourself. This isn't really about being right or wrong on this one Nvidia trade. It's about having a process, a system that is so strong, so clearly defined, and so mathematically sound that it literally protects you from your own worst emotional impulses, your fear, your greed, and your hope. So, is your plan strong enough to do that?